Well, U.S. trade policy has been driving economic and market uncertainty, but how should investors be navigating these choppy waters? Joining us now to discuss is Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, thanks for joining us again.
Anthony, it's great to be here.
All right, Brad, it's been a rough ride for investors, but put the volatility in context for us.
Yeah, the volatility has been pretty amazing. Maybe a great way of starting today is I confess that this is my favorite day of the quarter. Every 3 months we publish our portfolio strategy quarterly, and we published it yesterday and did all the calls across the globe and all the stuff introducing it. But we called it High Dough. And why High Dough, of course, for Canadians should ring true. Sounds when you blow it, High Dough is as familiar to Canadians as we stand on guard for thee. The basic idea of our PSQ this quarter is that there is an awful lot of volatility, and let's face it, in the geopolitical realm, there's a lot of chaos, and a lot of that chaos is translated into financial markets. And the idea of blowing at High Dough is that, don't make rash decisions. Don't rush into things or rush out of things, and make sure that you're making prudent decisions. So maybe a good start is I brought a chart along today, the one on volatility, and maybe if we pop that up, I think that starts giving us. That's not the one I was expecting, but that's it. That one tells you all you need. A good one. The good one, if you want to put it in that realm, is if you look at year-to-date returns and you look at fixed income returns, is the kind of flat across the board, and then all of a sudden you look at gold there, and you were talking about this on your way in, is that you get a gold return like that when you get across the globe that you're concerned about the United States as the stabilizer in the economy, and indeed that's not what we've seen. So if you kind of looked at the returns year to date, and even looked over the last month and tried to give it a little bit of context, and Anthony, it was something you said on the way in here today too, is I had to smile a little bit that saying gold is off. Gold went over 3,000 an ounce on March 14th, which has been just a remarkable tear. And the reason gold has been going up is first and foremost is this trade war, the volatility that is out there, which runs there's the constant theme through this. So when you look at what you're looking at your chart here, like this is equity volatility, bond market volatility, and currency volatility, and it looks like a heart rate monitor. And I think gives you an incredible indicative of what this world looks like right now, and what we were writing about in our portfolio strategy quarterly is to just. And it'd probably be the theme of the rest of our discussion here is that we are going to continue to see these, wild days. And I mean, we were going through the returns year to date that you had on your screen. I mean, if you sat back for a minute and imagine you were asleep for all of April and you woke up today and you looked at returns year to date, and take a look at this thing. You kind of you have global markets. Down 8-9%. You got U.S. leading the way, but the large caps down around 10%. I think you'd look at that and you'd say to yourself, "Oh, well, there was a correction." Now, there's been a calamity, a bloodbath. There's been massive losses, and A, that's what you'll hear a lot about this market, and B is that if you kind of take from Liberation Day, and for about 10 days the market was absolutely haywire. I mean, you can tell when the market's haywire when my team, what we do is we try to frame when things are going wrong, and in a span of about 7 days we published 4 or 5 articles and with 15 to 17,000 words on it, and now here we're sitting and. It's kind of like ho hum. A bit of a correction, and we're sailing from here. And I think that it's just been a remarkable time. And so I think we have to remember this time, and because I think we're going to see more bouts of it as we go forward.
Yeah, you talk about the trend of volatility, or the theme of volatility that we've seen over the first quarter. What about the Sell America trade? What are you seeing there play out?
Yeah, look, the bottom line is a theme that runs through our publication this quarter, and it's going to be a theme that frankly, we're going to be writing about, and we've been talking about a lot here, is, you know, if you go back, and just think about over the passage of time, decades, whenever there was something wrong going on in the world that was unsettling, that America was the stabilizer. The United States was the stabilizer. It's the place where you would go for safety. And so you look at where we are today, and you look at what happened in the month of April, was that United States wasn't the stabilizer. The United States was the destabilizer. And so the sell-off in assets that we've seen it has been the U.S. side. And so, if you looked at what led the sell-off, and I think I might have brought a chart along that will help kind of put some context on that. But looking at all the big tech names, I mean, leading the way was the Nasdaq, and then the S&P 500, and then through on that is the Mag 7 was the big driver of that. So you got to kind of look at that in two ways. One, you're prepared to pay a premium to buy these great U.S. growers. The flip side is that if you start thinking that there's great uncertainty in the U.S. market and in U.S. politics, like, markets abhor uncertainty. That is the one thing that markets just don't like. And so leading the way on this sell-off was U.S. companies, which is usually not what you're going to see. But we saw that here, and now I want to give another, maybe a cautionary on that a little bit, or another take on that is, Anthony, if you and I were sitting down last November or October and we were talking about something we thought that could happen or should happen, we would say, hey, a correction in the U.S. equity market led by tech is something that's, at the price levels they're at, would be something that probably makes a little bit of sense. And so, there was also a little bit in this market on the equity side anyways, was an excuse to say, okay, there it is. I can from institutional investors to say I can lighten up on my momentum and my growth and my tech exposures here, and this is kind of my tripwire to be able to do that.
Okay, so given what's happening in the U.S., you talk about looking closer to home, and you say that Canada is actually looking relatively attractive. Why don't you walk us through your thinking?
Yeah, look, first and foremost is one of the real remarkable things, if we look at kind of year-to-date returns, is that if you look across the United States, look globally, and you look at Canada, like, Canada has been a really good place to be invested. And so we've been overweight Canada. We've been overweight Canada since the fall of 2024. And when you're looking at that, I mean, today, year to date, you're basically flat on the TSX. And if you think of how much other correction that we've had around the world, that's a pretty remarkable thing. So why Canada? Well, first is I look at it in probably three different things you got to consider. First and foremost is that when you've had a correction like we have had, and where the tone of the market is changing, what's happening is the market is I think, outside of the days when the market is really volatile, I would say that the market's actually functioning in a really healthy way, and it's exhibiting what you would think would happen in a late stage, where you're concerned that the economy is moving towards a recession, which is, the big concern that is out there. So what you do, you start toning down your growth names, and you start looking for stability in your portfolio. And when you're looking for defensive exposure, if you look up defensive in the dictionary, there is a picture of Canada. Right? Like, we have financial companies and pipelines and telecoms and consumers and staples and utility companies. Those are the diversifier and the stabilizer in an equity portfolio. So one, it's where we are and where people are rotating their portfolios to. The second one is the election we just went through. And so I'm not here to get political. It for the market that I would argue that global investors, institutional investors who are allocating to Canada, first and foremost, you got to look at over the last year that institutional desks around the globe have really beefed up their capacity to allocate to Canada because of our stability on the defensive nature of our equity, but also we are in the middle of a global infrastructure build out, and that we do that particularly well. Now, so you build out that exposure, then you have a political campaign. In the political campaign, you had two different parties, and the two different parties, the Liberals and Conservatives, both had very different views on how to interact with the Canadian economy. But what they both agreed on is that there needs to be greater fiscal impulse here, because the concerns in Canada are really well known, right? Like we have concerns about inflation. We have concerns about that our labor market being under pressure. We have concerns about we have concerns here about our lack of productivity, the barriers between our provinces for trade, and ultimately a very difficult decade of lack of growth in Canada has been well highlighted in the political campaign that we just went through, but is also well known and been choreographed in financial markets. So even though you have those pieces to it, the flip side of the coin is you have this fiscal impulse that is coming. You have a defensive nature of what the Canadian equity universe is, and then your last piece is that in an environment in a world that lacks stability, Canada is an unbelievably stable nation and has a real long history of that. One of the things that are the concern in the marketplace right now is the lack of stability in the U.S., the concern about it as being the safe haven when it comes to having a stable and transparent political and regulatory environment. Canada has that in a really big way, and that's recognized globally. Our fixed income market, Canada holds a AAA credit rating. It has really reasonable and attractive yields in an environment like this one. All of those things portend to a positive nature of why investing in Canada. And the last one is that, I would assume, Anthony, that over the next few years, when you and I are sitting down and chatting, one of the consistent things we're going to talk about is global infrastructure and global infrastructure build out. And we are a nation who are going to be doing that internally with thinking about how we're going to build the infrastructure in our urban areas and what we're going to do with pipelines across this country. But we also do that globally really well, and that's going to be a high demand for our structures, our resources, and our know-how. And I think all of those are why you have a real strong case to invest in Canada.
Okay, so given that backdrop and some of those the headwinds that you've highlighted, what is your base case going forward?
Well, look, I think the base case for the TSX is that you ultimately have a market that is trading let's call it 15 times 25 earnings. You're looking at earnings per share growth of around 9%. You get a dividend yield for the TSX at about 3.2%. Now you compare that off of the S&P, which again we like the S&P as well, but just on a relative basis, 20 times for the S&P, earnings per share growth at 10 times, so basically the same sort of forecasted earnings per share. Dividend yield on the S&P is 1.4%. So if you put it in that context, this is a market that is well valued that has the defensive types of names where you want to have in an environment like this one. And so, I think our base case is that we continue to be modestly overweight in the Canadian equity market, and we think it continues to be a real excellent place to be invested.